Welcome back. We hope you enjoyed that brief intermission. We are now joined by our next team, Cava Capital. Congratulations on being a finalist in the MIPC this year. Team, you will have 10 minutes exactly for your presentation, after which we will move into a 20-minute Q&A with our judges. I will begin the timer when the first person starts speaking, and best of luck.
Good morning, judges. We are Cava Capital. We are very excited to present our net zero solution for Super Easy. Currently, it faces three trade-offs. Firstly, while it wants to move away from carbon-intensive industries and lift the brunt of ESG security selection, it may lose some extent of diversification. And secondly, if it invests in green securities and divests entirely from fossil fuels, it may sacrifice returns, as green securities may be overvalued and the fossil fuel is a significant part of global energy. And lastly, if it captures the benefits of sharing market risk internationally and invests in cleaner economies, it may fall short of the social responsibility of supporting the local economy. And therefore, we arrive at three objectives: robust ESG integration, long-term capital appreciation, and balancing the seesaw. I'll now pass on to my teammates to talk about our strategy, which will be divided into three stages.
In the first stage, Super Easy must immediately start its net zero transition. It should also aim to capture opportunities arising from the current high-yield environment. In addition to reallocating its assets, Super Easy should also initialize a robust ESG framework for its net zero transition. The fund could utilize the weighted average carbon intensity to measure Scope 1 and 2 emissions of individual companies. We believe this to be a superior metric. It adjusts emission weightings according to the fund's allocations and has a greater tolerance for emissions of companies producing more value. Super Easy should also set up a net zero committee. It monitors the transition progress by carrying out internal and external functions. On the internal side, it assesses ESG scoring, screens out holdings with insufficient carbon disclosure, and starts expanding the alternatives team. On the external side, it will use voting rights to make impacts, monitor the decarbonization progress of firms, and start developing engagement teams. The Net Zero Committee ensures that the net zero goal can be achieved by 2050. Aside from having a solid net zero transition plan, the fund should also reallocate its assets strategically. It would integrate carbon emissions into its quantitative portfolio optimization process so that the fund can obtain an optimal trade-off between carbon reduction and financial returns. Super Easy could gradually adjust its sector allocations over time. Along with active engagement with companies through the Net Zero Committee, the portfolio's carbon intensity is expected to be reduced to around 300 units by 2050. Carbon negative investments will offset the remaining carbon intensity. I will pass it on to Alex to go through the bond strategy and the geographical allocation.
Thank you, Vincent. So other than the equity aspect here, we also initiated our plans on the fixed income. Purchasing green sovereign bonds and investment grade bonds help us to generate attractive return in this high yield environment and allow us to fund further funding the government projects on reducing the carbon footprint. So overall, this kind of allocation could achieve a higher returns while also serving the social responsibility at the same time. So moving on to the geographical allocations part. We suggest that Super Easy uses the CCPI index as a proxy to reallocate your assets among different countries. So the higher is the CCPI, the better that the countries are tackling the climate change. Therefore, we overweighted the EU and the UK while underweighting the emerging markets. Since the US market also has a long history of outperforming other markets, we decided to maintain the exposure even though it ranks relatively lower in the CCPI index. Basically, that's our plan for stage one. And I will now hand over to Christy to discuss the stage two transition planning.
So thank you, Alex. In stage two, we aim to attain net zero using alternative by starting the capital deployment and using derivatives as hedging. The fund would need to return the strategies for investment in local Australia firm. So to balance diversification and decarbonization, the fund would utilize alternative as their diversifiers. Shifting the allocation to alternative require the fund to assess structured governance, a more cautious decision-making process, and an expansion in team size. The fund could leverage the third-party expertise to meet the sudden surge in resource demand and in-house fund management in stage 3. So the following illustrate the strategy of 4 asset class for alternative. The fund could take a more defensive approach and incorporate the ESG framework for the new asset class, private credit, which focuses on middle-sized senior secured debt and non-cyclical sectors. In other asset classes like infrastructure, private equity, and real estate, the security selection concentrates on creating a sustainable impact in different sectors and the existing portfolio. For example, we will fund PE by restructuring the business model to align with net zero and efficiency. So in stage 1, we've mentioned overweighting the EU market and underweighting the emerging market. In stage 2, the fund will fully resolve the dilemma of geographical allocation. Australia's attain a very low CCPI rating since the state is taking a technological approach instead of decarbonizing the fossil fuel sector. The uncertainty in the climate policy actually harms the portfolio futures return. Therefore, we suggest underweighting Australia equity, but taking the pension fund's responsibility to support the local economy toward net zero transition. The fund could invest in SMEs with PE investment to enhance their labor demand and renewable energy infrastructure to fund their infrastructure for net zero transition. Additionally, the fund could directly engage in equities and invest in some transition bonds to finance their high GHG emission industries to aid the decarbonization. So pass on to Alex to talk about the derivatives hedging strategy.
Thank you, Christy. So to hedge against different kinds of risks here and help us transition the portfolio to other stages, we propose using options, futures, and carbon derivatives here. In tackling the overvaluations in the green assets, we suggest using options to hedge the MSCI ESG index by market timing and sacrificing 5% of upside to protect against the 15% downside movements. And on the other hand, along all the way from divesting from the fossil fuels, it might diminish our returns greatly. Therefore, we propose taking a long position in WTI futures to take on exposure of the oil movements. And lastly, for the carbon derivatives, we suggest that should be easy to actively involve in both the regulated and voluntary markets to trade the carbon credits and increase their carbon negative investments. So moving on to another stage 3, our portfolio will fully attain the net zero by balancing the 3 trade-offs here. Also, the fund will also increase the internal managed portfolio to cut costs going forward. External asset managers have high management fees. So to internalize the management structure here, the fund could hire some in-house talents globally with some solid industry expertise. The fund could also expand the internal service team by hiring more legals, operations, technologies, and even ESG expertise to support the heavier workload from the non-due diligence process of the alternatives. So on the other hand here, some external party investment consultants will remain to provide a different view on the strategy as well. So overall, that's the basic idea of our stage 3 portfolio. And I will now pass on to Angus to talk more about the impact to the stakeholders and the conclusion.
Thank you, Alex. So apart from having a fund, our strategy benefits various stakeholders. For investors, Super Easy can generate over 7% annually to offer attractive returns. For the Australian government, the fund invests in SMEs to provide more job opportunities and also provide institutional investments to accelerate the country's net zero transition. And finally, for domestic companies, the fund would overweight PE along with ESG engagement and monitoring. Stewardship would also benefit local firms' operations. The fund would even assist companies in renewable technology development. Super Easy is determined to achieve a portfolio-wide net zero by 2050. With a 10% reduction target in stage 1, a 50% reduction target in stage 2, and a 100% reduction target in stage 3. We firmly believe that the 3 stages would cater for both sides of the trade-offs to not only support the fund, but also give a helping hand to the environment. Thank you. We now open the floor for any questions you might have.
Thank you so much, Cava Capital. Excellent presentation, great work. So now we will be moving into the 20-minute Q&A portion. And judges, we are all ready and waiting for your questions. Yes, Gareth, please go ahead.
Great, thanks for the presentation. I like the way you put the trade-offs together right up front. So thank you very much for doing that. It makes it very clear. One question is, as you shift maybe away from Australia, especially on the public equities, what do you think the impact would be on innovation and new firms and firms to put money into R&D over time? Do you think there'll be a I don't want to say financial instability, but there'll be an impact on the general economy of Australia over time? What are your thoughts there?
So perhaps I can address your concerns, and if other teammates have any add-ons, they can also add later. And so in our strategy, we actually underweighted Australian equity, and we believe that because the reason why we underweighted Australia is because actually Australia takes a technological approach in trying to get to net zero. And so therefore, Australia didn't actually have any new policies in phasing out coal or gases, but they have a huge investment into the technological aspect. So that's same as what you have mentioned, the R&D cost. And we believe that Australia actually has a huge intention to fund this technological R&D. And so what we believe that is we can actually invest in transition bond to and also some Australian government green bonds to help the Australian government get to the targets that they are aiming for using these government investments. And on the other hand, we also target on the private market and to support those smaller companies and those private companies to develop these technologies to get to net zero. So we believe that we actually have an all-round approach towards helping the Australian economy to get to net zero and not affecting the general economy. I hope that addresses your concerns.
I think I can add a little bit more. So I think overall our transition is slightly doing a little bit at a time. So each of our stages actually lasts 10 years and longer. So it means that we won't have like a large evacuation at a time. So our divestment from the Australian public equity will be slowly and smoothly transition planning. And we also emphasizes on the private equity to invest more on the Australian market so as to support the domestic market, and for the funds who are putting on their focuses on the R&D that concerns about the ESG development, we'll be putting more resources on there and allocating our investment on the field.
All right, thank you very much, team, and thank you, Gareth, for kicking off our Q&A. Why don't we move on next to Patrick? Go ahead.
Yeah, I'm actually it's a follow-up on the previous question. Is the proposal to use alternative measures to have an impact on the Australian economy, is it really part of the mandate?
I think that it is. So it is a part of our mandate. So basically, go to summary. Okay, so we have this kind of reduction target for these 3 stages. And the mandate that we designed for Super Easy is that we actually have a huge allocation towards the alternatives part. So if we look at this detailed asset allocation, the strategic asset allocation of the 3 stages, you can see that the alternatives go from the initial 32% up to 43%. So we believe that this design of mandate for Super Easy is to target on alternatives as a main means of attaining net zero.
Thank you, Angus. I would like to add a bit on my teammate's explanation. Could we go to slide 47, please? Right, so here we are at stage 2. So we divested a bit from the Australian equities, and we plan to increase our investment in alternatives. And in particular, we will invest in infrastructure and real estate. To increase our carbon negative investments, we will increase our investments in infrastructure, and that will include something like renewable technology, EV charging stations, etc. And we believe that these investments would bring a positive impact to the environment, and thus it would bring in more more carbon negative investments into our portfolio.
All right, thank you very much, team. Our next question comes in with Jamie. Go ahead.
Thank you. I had a question on stage 2 elongation. I think on slide 17, you talk about, different levers that could be used. And one of them is to use WTI oil futures instead of, I guess, allocating towards the energy sector. How do you come to the conclusion that that would increase returns? And how did you think about, I guess, exposure measurement on the basis of carbon emissions, given that there are clear, sustainability concerns around oil as well? So I just quite wasn't really understanding the logic there.
Maybe I can address your questions, and thank you very much for asking this. Angus, could you go back to another appendix about the derivatives part? So in here, the reason why we are choosing to launch the WTI futures is because first of all, we want to take more capital to more concisely and more efficiently to put on focuses on other areas. Therefore, we use the derivatives to provide a leveraging effect for us to use more cashes, make it more available for other investment in the alternatives and private equities and for the alternatives part. So that's the basic, the main reason, the first reason why we use the derivatives here. And for the second reason, addressing your concern about the sustainability, the ESG problems there. I think our basic idea is during the process of divesting from the of oil field and the fossil fuel sectors, actually, we all know that that's like a sector that has like a major concerns and a major problem there. And I think the idea here is as long as we don't settle the WTI futures, actually we do not hold the underlying of it. So it's just like when you're holding a contract, it's just a fractional form, but it's instead of a real form there that you're holding the underlying asset. So we believe that by launching the WTI futures, it doesn't mean that we are increasing carbon intensity there, and we are not causing any more support towards this environment, support over these oil fossil fuel sectors, but instead we are doing greater returns, and we are also balancing the requirement that we have to divest from the oil field sector.
And I would actually like to add on a bit. So we know that actually using derivatives is not the best strategy because we have other better strategies. We have investment in alternatives. We actually allocate more resources to help the development of technologies. And so we believe that this derivatives strategy is only for the short term to accelerate our net zero transition in the early stage too. And in the long term, this strategy will not be the main strategy. We actually leverage more on alternatives and as a long-term sustainable solution to get us to net zero.
So, sorry, just to build on that, in the alternative space, like where is that investment happening, if not in the energy sector, where you'd expect to see the innovation taking place first? Like to me, that sector could entirely be perceived as undervalued today, just given the time frame that you've sort of earmarked for stage 2.
So perhaps I could also address this question. So can we go back to the slide for the derivatives? Sorry, for the alternatives. So slide 47. All right, so for stage 2, we would use a bit of the derivatives to provide stability of returns. And in stage 3, we will slowly decrease our investments in derivatives and switch up our investments into alternatives. And in particular, we would focus on renewable technology and green technology. So we believe that doing so would bring similar effects to like investing in the derivatives because they are exposed to the same sectors and the same risk factors. So we will not consider derivatives to be a part of our long-term strategy, but alternatives to be our long-term strategy instead.
All right, thanks for that, team. Let's move on to our next question coming in from
Thank you guys for the presentation. Maybe just a follow-up on the derivatives until I get to my actual question. How are you planning to treat emissions from your derivatives exposures, as there is some difference of opinions in the market currently on that?
Thank you for your question. So we understand that there's a lot of controversy behind the carbon accounting of derivatives, and it's a really complicated topic, and there's a lot of debate going on. We currently do not take that into account for our carbon emissions, and there are mainly a few reasons for that. So firstly, we do not settle our futures. We do not hold our futures until settlement, and we only do so to hedge our portfolio and to do it for speculation purposes. And secondly, we will try to do the futures contract with counterparties who are also doing that for speculation and hedging purposes. So we would prefer not to enter into future contracts with producers and consumers of the oil, of crude oil. So we hope that it would actually not harm the environment by taking up derivative positions. I hope that answers your question.
Sure. And if I'm allowed, Tina, also just on the lack of data in general within with carbon disclosures and in the ESG framework in general, in terms of your allocation to private debt, how are you going to treat that lack of data, given that generally listed equities have the most disclosures currently?
So perhaps I can give some insight on this. So here we can see that there are a lot of ESG data providers that we are going to use. This can be used for green bonds and also equities investment. And then for private credit, we actually also discuss with the firms. We actually have to know about the firm's aim, and also require them to have some sort of reporting for us to do some estimation on the carbon emission or some carbon negative impacts that they are going to produce. So we are actually not going to purchase private credit just because the private credit is going to drive returns. We actually look at the company and we value the carbon negative impacts it generates more than the returns that it can bring. And so we actually value the reporting and also the transparency of those firms. And this is what we require when we first choose to invest in these firms. And the same goes for private equity as well.
All right, thank you, team. Sounds good. Moving on to our next question. It comes from Audrey. Go ahead.
I know. Thank you very much for the presentation. I guess leaning maybe a little bit back into your use of derivatives, there's 3 different components of derivatives that you're planning on using. I guess how have you accounted for the risks associated with increased derivative usage? And here I'm really thinking of it in the context of liquidity management. I did not see any changes in your cash holdings, and I am seeing a reduction in your fixed income holdings. So how are you, or how have you taken that into account in your projections as well as in your portfolio mix?
Thank you for your questions. So Angus, could you go to the cash usage of cash, that page? So maybe I can answer for the cash parts. So the reason that we have kept the cash at constant stages is because there are 4 main usage for it. So for the first one, we want to use it for a margin requirement. So when we are doing some long taking exposure on the derivatives or even shorting some positions, there are often some margin requirements on there. So we want to put it on a maintenance margin. So add as a reserve that could be acting for a reserve there. And for another part is about the flexible TAA, which means that we want to provide some liquidity for the tactical asset allocations here. When we are sometimes the market is up or down, we want to deviate ourselves a little bit from the strategic asset allocations. So we want to have the cash level to be ready at there to use And for another part about the pension payouts, and we have to make sure that there is sufficient liquidity for there. So I guess the cash is kept at constant level is 3% is because of that. And also another point, sometimes when we have extensive cash and we can also invest in the money market instruments, because when you are investing in money market instrument, it actually means that you can actually put it out on a T per 0 day. So it means that you can take it out on the same day if you're investing in such a fund. And it's partially invested to generate a lower and more stable returns.
All right, thank you very much, team, and thank you, Audrey, for that question. Our next question comes from Mohammed. Go ahead.
Hi guys, congratulations, great presentation. I had a question on liquidity. I think you answered partially to that, looking at liquidity from a short-term perspective, but as you are increasing alternative investments across time, have you thought about how you're gonna manage with liquidity more strategically, long-term? And my second question is, can you maybe more of a broad question. Can you share more details about the quantitative optimization, as you are saying that you factor in carbon emissions?
Let me answer the first question first. So actually for alternative part, it's actually in stage 2. It's a stage that we start to hedging by derivatives and increase the allocation of alternative at the same time. And so the alternative, actually, it takes a really long time to deploy the capital for the capital cost. So for the derivatives, it actually acts as a gap filler for those of the capital waiting to call. Therefore, except for the 3% cash that Alice has mentioned, there's actually source of capital from our alternative to for hedging and maintain some level of liquidity.
Thank you, Christy. And perhaps I could address the second question about the portfolio optimization process. Right. So we considered the traditional portfolio optimization process, which we can see on the top left-hand corner, and we added some improvements in the bottom left-hand corner. So we added an extra term in our objective function, and that term gamma CX actually accounts for carbon emissions. So we try to penalize the objective function by adding in the carbon emissions into the function, and roughly 100 tons of CO2 emission per million cells will be equivalent to 1% of returns. So this will give us a quantitative way to balance the trade-off between risk, return, and carbon emissions.
All right, thank you very much, team. I believe we have time for one final question today. So Kelly, go right ahead.
Thank you very much. I have a question on slide 23, please. If we could go to that. Thank you. So I'm just looking at stage 3 specifically, and if I look at your investments in Australia, we've got Australian equity 7, private equity Australia 7, infrastructure Australia 7, and sovereign bonds 5. So that, if I calculate, that's about 23%. So what would be the consequence on Super Easy's brand and reputation and our relationship with the Australian government and people of only investing 23% of the fund in Australia? Thank you.
So I guess I can address the problem, and if other teammates can also add on, maybe. And so we can go we can talk about each stakeholder. So first one for the investors. Obviously, investors, they're mostly concerned about like the returns. And I think that as long as we provide enough returns, then they're going to be satisfied. And then for the Australian government, we believe that, so actually you can see that we are actually decreasing the allocation to Australian sovereign bonds. And this is because of the lack of policies to phase out some fossil fuels. And we believe that actually the Australian government is not doing good enough currently in terms of its net zero transition phase. And this is only for the status quo. And so if we force Australia going to have some policies on tax and also to cut some oil and gas usage directly, then if we see this kind of approach, we may choose to overweight on Australian sovereign bonds because we agree with their approach and we wanted to help with this correct approach. And so this is what I believe to be the relationship between Super Easy and also the Australian government.
Excellent. Thank you very much, team. We will unfortunately have to wrap up Q&A there, but once again, thank you for your presentation and for the Q&A. We will now be taking a momentary break before we welcome our final team of the final competition of MIPC. That would be Team Trees, and we will see you all very soon.